everybody to this quarterly review, first one for 2025. Apologies for the slight delay, a few technical issues there, but anyway, we're here. So we've got a few questions today as well, but I think we'll potentially just have a look at the content of what we want to share with people, because there have been a lot of interesting things that have happened, especially in relation to the RBA, but also many other things that we think we need to look at. 2025 is just starting off, and it looks like it's going to be a pretty interesting year. So here's a disclaimer. This is all general information, not personal advice, so please be aware of that. And if anyone does require that, of course, they can reach out separately to us at any time. So moving on from here, just for people who don't know us, just to give a little bit of an overview of what some of the group entities actually do for people. Wise Guru was established with specifically Australian expats around the world in mind, and assisting them with financial transactions, generally speaking, related to property purchases and funding those and streamlining the whole process. But our other businesses that we have, Unicorp Partners was originally founded 36 years ago, and helps, generally speaking, in the medical profession, but other busy professionals and business people and people who work for large multinationals with their financial advisory needs. Aussie Loan Guru is our lending business, and again specialises in helping people in the professions in Australia and Australian expats overseas with their property lending needs. And Aussie Property Guru is our Australian real estate business that focuses on property, as the name suggests. So without dwelling on that too much, we'll move through and just move on with what's going to be, I suppose, of most interest to people. As the people who are viewing this for more than the first time know, we generally deal with higher income earners, people who are very time poor, but they still want to, if you like, utilise property as part of their overall asset portfolio. They would like to make better informed decisions, but they don't have the time to perform all of the necessary research themselves. And they want to be, perhaps a little more conservative in some of the ways they want to build their asset base out, but they do want to be very tax efficient and make sure that it's affordable, and that they're actually doing this in a process-driven manner rather than just ad hoc. So, that doesn't matter if you're a surgeon in Sydney or a banker in Hong Kong. That seems to be the sort of thing that people have looked for and continue to look for. We provide a concierge service which I guess facilitates all of that around the property purchase angle, where people require funding, they require assistance to make sure that they don't make any of the multitude of mistakes that can happen when you're buying a property. We assist people with a bunch of panel experts in the various fields that we can refer them to for legal advice, for tax advice, for accounting, and so forth. So we try and make it a very streamlined situation, and we charge $4,950 for our concierge service. So let's have a look now what people are asking, because these questions have sort of remained similar over the last few months, but now they've changed because the RBA has just come through on Tuesday with their first rate cut since November 2023. So, a very long time, and I think it does mark the beginning of a rate cutting cycle, even though we've seen a lot of commentary in the press, and even the Reserve Bank Governor, Michelle Bullock, is coming out and being quite hawkish, saying, perhaps we're not going to get any more cuts in the near future. I don't really see that happening. I think that we potentially will get more cuts coming through, and I expect we'll have one, in the second quarter of this year. But these are the questions, and a lot of people have been saying, well, we're now seeing some fixed rates which are a lot cheaper than we've seen for a long time. Should we be fixing into those? Will the RBA continue cutting rates, and how quickly is that going to happen, and by how much? How will this new reduction in interest rates impact property prices? These are all great questions, and we'll go through and answer those as we go along with things. People are still asking me about, which markets provide the best growth opportunities, and still about the work from home situation. There's been, a lot more commentary about that in recent months, but it's still over 36% of people work from home, so that's much higher than the number pre-COVID, and I think it needs to be recognised that this may remain in force for the very long-term future. Which areas are showing the highest population growth, because there's been a bit of a shift around the different states around the country. And the other question that always arises is around rents. Will rents continue to increase? So here it is. We've had to wait quite a long time, since 2020, when the rate hiking cycle first began, that we've actually had our first 25 basis point rate cut. And as I said earlier, I think this is something that's going to continue. The four major banks, their economists have penciled in 4 interest rate cuts. Sorry, one of them penciled in 3 interest rate cuts for this year. And I think with inflation moving into the band as we're seeing at the moment, I think 4 interest rate cuts are probably something that is going to be the outcome at the end of the day. So, we had the slide in the last review, but Australia's finally joined the rest of the world in cutting interest. We've seen central banks all around the world start their cutting cycle over the last year, except for Australia, and that's now coming through. And I think the transmission mechanism, as on the way up, where most Australian mortgages are now on variable interest rates, will also be fairly rapid. So all the major banks have come out straight after the RBA decision and said they're going to pass on the full 25 basis point interest rate reduction, but that will take sort of between 10 to 14 days to actually play out, where borrowers will actually then be paying less on their repayments. And I think it'll happen quickly. I think the most important thing really is not just the reduction in payments, but also people feeling that they've waited a long time and now things are going to happen to assist them in terms of a lot of the cost of living pressures and just financial pressures in general. So research is really important. It's something that we treat very seriously, and I think people need to recognise the fact that if you can't do it yourself, it's probably a good idea to have someone help you with that and do that. We utilise, a lot of the government figures, MB.BS, the Population Centre, CoreLogic, Urbis, Resolution Research and so forth, a lot of national providers of data. And then we put our own overlay over that, because we've had, over 3 decades of experience in doing this. So it's really important to actually be able to sift through the data and see, how that relates to people's outcomes in the real world, I guess. So down to 4.1% now is the official cash rate in Australia as of this week. The commentary just before that, even just before the RBA meeting, was still, are they going to cut? Are they not going to cut? And various people were espousing different reasons for both courses of action. But anyway, it's now a historic event, so it's happened, and I think probably was the right move for the RBA. We predicted this rate cut, over 4 months ago. If you look at the last quarterly review, which is online, you'll be able to see that there. I thought that the RBA would cut in February, so hopefully we're still on the money and they'll continue with another rate cut in Q2. April may be a little bit too early, and I think a lot of that will potentially be impacted by when the current Labor government calls for the federal election. We all know it has to be held by the 17th of May, but I guess the the smart money, if you like to call it, is sort of pointing to perhaps an early to mid-April election date being called. I'm sure we'll find out pretty soon. So if we look at housing credit, because it's an important thing, over the course of this time up till now still, interest rates were relatively steady for all borrowers. As I said, the 25 basis points won't cut in for another week or two. And variable rates for both owner-occupier loans, investor loans remain pretty steady. But we should now see, hopefully, the beginning of this easing cycle helping people through the rest of the course of 2025. You can see there variable rates, fixed rates. There was, I should mention, that some of the major banks have come through in the last 2 weeks with fairly chunky fixed rate reduction, interest rate reductions for their 1 and 2 year rates. But again, and this is a question we've had from people: should I fix? It's a difficult one from a 1 year viewpoint, but certainly if you're looking at 2 year rates, I can't see the sense in fixing at this stage when you've just embarked on an easing cycle. Although many people still espousing the fact that they think inflation is going to remain stubborn, and there are calls for the RBA not to deliver any further interest rate cuts this year. I think that's incorrect. The other question that we're still getting is, how can values keep rising in this sort of high interest rate environment that we've been living in for the last couple of years? And we've looked at this before. The reason is still the same, and we're still seeing it. It's not just wealthier buyers with higher deposits, but it's a lot of people buying with cash. So there are a lot of purchasers in the market who have perhaps bought a house 30 or 40 years ago, have decided to sell it, have made very substantial capital gains over that time, and they're simply going into the market and buying other properties with cash. So interest rates are not going to impact them. The other side of the equation, we're looking at increasing demand for some of the lower value, the cheaper markets. People are looking to buy apartments rather than freestanding homes. They're looking at perhaps getting assistance from their parents or grandparents. And we've also got to look at, there's a massive shift obviously with inheritances coming through to people. Trillions of dollars are going to go through the system in the next 10 to 20 years. So all of those things point to the market continuing to be, I think, not rising, but stabilising. I think there'll be a sort of a tale of two halves. We're seeing that in various markets around the country where, certain markets are weakening now. But I think if we do get those interest rate cuts that we're anticipating and the banks are anticipating, then that will add further impetus to the markets later in the year. So this is what Westpac thinks. And as you can see, that was Monday, on February the 14th. When the cash rate was still 4.35, it's now 4.10. They think that June will produce, another rate cut, another one in Q3, and another one in Q4. So I think that's, broadly speaking, a pretty good sort of pattern to play out. And I think many of the people we speak to outside of Westpac have a similar view on that. The interesting thing that I think I want to point out here, especially for our Aussie expat clients who are living overseas, working overseas and earning an income in foreign currencies, if you look at the AUD US dollar forecasts here, they seem, I think the Aussie dollar is struggling at the moment, and I think it needs a move up obviously in commodities, but it needs China to sort out their economy and move up. Thank you. So, lots of things I suppose need to fall into line to give the Aussie dollar a boost. Now, for our expat viewers, clearly that's a massive benefit because they have the opportunity of having a currency tailwind, especially if you're earning, say US dollars or Hong Kong dollars or quite a lot of other currencies too in the basket. But you're getting a bit of a bit of a free kick there to be able to purchase an asset like Australian property with that advantage. Doesn't help us or the Aussies living in Australia, but someone has to win most of the time. Now, if we look at the other question that we have around where people are moving to, where are the areas of high immigration, both from international sources and also domestically, then the latest figures, and bearing in mind these are quarterly, you can see there from that graph, rate of immigration and population growth has peaked, has slowed, but it's still really, really strong. I mean, population growth to the end of June was 2.1% nationally, and Australia's now ticked over the 27 million population mark. Still very strong immigration coming into the country if you look at other nations around the world. And I see that continuing because, as we've said over the years, Australia is a very popular destination for migrants from many parts of the world and will continue to be that, and I think offer that sort of sense of stability and security that people search for. So these are the projections that were made a little while ago now, but as we can see, the trends that were forecast and the projections, I think, will come to pass. So you've got WA now for the last couple of quarters being the fastest growing area around the country, 3.3% growth over the previous year. That was followed by Victoria at 2.8% and Queensland at 2.6%. So those states seem to be growing at very high rates, but as we can see, that is forecast to reduce quite sharply, particularly for WA, which has had such a large spike, and also for Victoria. So if you look at that and then put into context, we look at lots of data sets, but the value of home lending has just seen its first decline in 7 months, and not very much, I might say. The value of new home lending fell by 0.3%, so I don't think we can read too much into that. And both investor lending and owner-occupier lending dropped. But as you notice there, the ABS has discontinued the monthly lending indicator data set, so we'll now switch to quarterly reports. But I think the trends that you see playing out in these graphs will continue. You can see investor lending has been growing very strongly and certainly is above its long-term average. And I think that may also be influenced by people who are investing. So they're saying, look, we can't afford to buy the place that we want to live in, but we do want to buy something. So they're going out and buying something as a property investment and then paying rent to live in a home that they actually want to live in. So I think that's partially responsible for some of that disparity in lending there. The other thing that is important, I mean, the regulators look at this, we look at this, everyone looks at this in terms of, and I don't know why people call it the riskier type of loans. I don't know if that's the right terminology, but I think we all know what's meant by it. So, high LVR loans, lots of interest-only loans, high DTI loans, so the debt to income. So that, as you can see, the shape of most of those graphs is pretty encouraging. So most loans that are originated in Australia are still very conservative. We have seen an increase in interest-only lending, and that's really for people to try and cope with the high interest rates that we're experiencing at the moment. So it makes a lot of sense, doesn't make it riskier. As you can see here, LVRs have remained pretty steady over the time. Loan to income ratio higher than 6, that's dropped away. So it's a really interesting picture, and one that really doesn't perhaps seem realistic, but it is. I mean, that's what's happening, so we need to bear that in mind. So the market's pretty robust. So if we look at property all round as an asset class, it's a pretty important one for Australia certainly, but for most nations. It's a residential real estate now makes up $11.1 trillion worth of assets for Australians. It's 11.3 million dwellings. And the interesting thing is that I always point out to people, there's only 2.4 trillion of outstanding debt on that whole asset class. So again, very conservative, quite robust, and I know for most people that have a loan or have a mortgage, they think that everyone is in the same boat, but obviously when you look at that, that's not the case at all. In fact, only about a third of Australians actually do have a mortgage. So what happened over the last 12 months in terms of home values, because people always ask us about that? Well, they went up in aggregate 4.3%. But you are starting to see even more of the disparity between different markets, different asset sort of types, where apartments have overtaken freestanding dwellings in terms of price growth in some of the markets. And look, this has been a slowing growth market, if you like. So we've had growth for a very long time, but the rate of growth has changed. And if you look here, by quartile, the most affordable end of the market dominated growth over the past year nationally, and the lower quartile was up nearly 9.5% over the year compared to 1.5% seen in the most expensive upper quartile. And again, this has generally followed the same pattern in most of the developed capital city markets that we look at. So this gives you a better indication of what's been going on. It's a 3-monthly change, and Adelaide, Brisbane, Perth, and Darwin were all positive. Melbourne and Sydney showing declines, and Canberra, has now joined that cohort, and I think we'll probably see that play out for the next quarter as well, where you're going to have the slowing growth being amplified, I think, in Melbourne, Sydney, and the rate of increase or the rate of growth being diminished in the smaller capital city markets. Again, interestingly enough, the regional markets actually had an upkick over the last month and quarter, where capital city markets had a very mixed result. So regional Australia is proving quite resilient and strong again, and I think that probably has something to do with the actual value of homes in those regions being a lot more affordable than the capital cities. So if you look at that, Melbourne down 2% for the quarter, Sydney 1.4%, and Adelaide was the highest at 1.8% over the quarter, as you can see, Brisbane and then Perth. So Perth is starting to fade a little bit as well. They've had a very stellar run, but we'll come to that afterwards. And then, we look at further granularity. You look at the different quartiles of value in those markets, and as you can see, the upper quartile in both Melbourne and Sydney has suffered the largest declines, and Hobart as well, as you can see there, but the gains have been the highest in the lower quartile in Adelaide, Brisbane, and Perth. Darwin's had a pretty sort of across the board increase, as you can see there. That's sort of been percolating away for the last 6 months. So we'll keep an eye on that. But a lot of these things are really driven by supply and demand. and there's still a massive shortfall in supply. As we can see there, in calendar year 24, 170,000 new dwellings were approved, and although that's up just under 4% compared to 23, those levels were nearly 17% below the decade average and 40% below the 240,000 dwellings a year needed to meet the government's 5-year target of producing 1.2 million new homes. So the shortfall, I think, underpins the property markets in many areas around the country, certainly the ones where people want to live. As we saw earlier, international migration is still very strong. And then, of course, we look at interstate migration. We'll have a look at that a little bit later. But you can see there, I think this is not something that's going to go away in the next 2 to 3 years. I think we're going to be stuck with this undersupply situation for quite some time. Now, this is a question which I often get asked by people, should I be investing in shares or in housing or in property, and which offers a better outcome. I think it's important to actually diversify, and I think both of these are good growth assets. They just have different characteristics. If you look at this graph on the right hand side, you can see that what happens to property values is a lot smoother than what happens to equity values. And the reason for that is equities are mark to market. So, you can look at a screen and get the instant pricing on something immediately. And so that will lead to far more short-term volatility. Now, that in its own right, if you have the right attitude, is not going to impact what returns you're going to get. But a lot of people, obviously, it's human nature, and if things start crashing, quite often we find that people start selling out of things. That's one side of the situation. The other one is, and this is really important because most investors try to maximize the amount of leverage or lending they can utilize with those investments to obtain the greatest tax benefits and to also enable them to expand their portfolios more quickly and build more wealth over the long term. However, if property comes down in value 10% or 20% next week, the bank doesn't call up and ask you to contribute more cash funds to equalise their loan to value ratio. But if you have a margin loan against equities, against shares, then that is what happens. So if you have a bout of volatility, strong movement downwards, the lender will say, look, by 10 a.m. tomorrow you need to supply X dollars more to bring that LVR into line under their mandates. So I think they're the really important things to bear in mind. It's if you use debt, be careful, and if you use debt, make sure you have sufficient funding available should you need to contribute monies quickly, because otherwise your assets will be sold out at potentially a bad time in terms of value. And still diversify. Perhaps a lot of people will look at this and they say, well, we might invest in shares in our superannuation funds, but we're not going to use lending. We don't have to worry about that, and we're going to invest in property and maximise our lending to gain the maximum tax advantage. The other important issue, and has been certainly in the last number of quarters, the rental market has risen strongly, as have values of properties, but rents have moved up, and that's helped a lot of investors absorb some of the impost of higher repayments due to interest rates going up so quickly. So, what will happen with rents? Well, I think, rents will probably continue to rise, but the rises are going to diminish somewhat. So I think, overall pretty good picture, and we're seeing, rents going up still by, say, around 5%, or perhaps a little more, but that may slow down. And on the other side of that, of course, we've got the RBA now having embarked on, I think, a cutting cycle that should help the landlords in terms of meeting their repayments, not having to rely on very strong rental increases to try and make ends meet. So if you look at it there, annual growth in rent values has eased to nationally 4.4%. As you can see, that's come down from a very high peak, and it looks like that may continue. I can see that continuing, for the next few months. But then, obviously, I think it'll start finding a level and potentially going the other way. But if you have a look at yields, they've remained pretty steady at 3.7% for quite a long time now. So we've seen shifts in capital values, and that obviously impacts yields. But as you can see, the nominal amounts, the actual dollars of rents, have also gone up and kept yields pretty steady. But obviously different markets have different yields, and as you can see, regional Northern Territory and Darwin are sort of way above the pack in terms of where yields are at the moment. And I think that's a pretty robust picture there. So it's still difficult for people to find properties for rent. And certainly there seems to be competition for that. So whilst that undersupply continues, again, I see things remaining fairly similar to what they have been. So perhaps not the best news for people who are wanting to rent something. And I think probably conversely reasonably good news for people who have investment properties they're renting out. So what do we do with the data? How do we use the research? Well, a lot of people say what's happening in the property market in Australia, and as our viewers certainly know, we hasten to enlighten people to the fact that there are so many property markets around Australia that we need to look at a whole lot of other things if we actually want to invest in an asset in that asset class. There are certain changes that have come through over time. This one remains sort of top of mind for us. COVID-19 really has changed home buyer preferences, where initially everyone wanted to move to the greener pastures, as it were, sea change and tree change, and they wanted larger dwellings. So we saw, particularly in capital city markets, people wanting to have more spacious 3-bedroom apartments sort of designed for owner-occupiers, or large 2-bedroom apartments with a multi-purpose room where they could set up their home office. And that seems to have continued. Even with people that don't need a home office, that multi-purpose room is still a pretty good sort of added functionality that we see people wanting. And I think that's going to remain with us too. As I said, the amount of people working from home is over 36%. So something, it's a reasonably large number. We look at new listing activity across the markets, and as you can see there, Canberra was, the only capital to see an increase compared to last year, up 0.2%, but both Adelaide and Hobart saw new listing levels 10% lower than this time last year. That's always something to bear in mind. There don't seem to be any significant levels of distressed sellers in the marketplace. So again, that sort of is underpinned, I think, by this lack of supply. The dampening factors have been certainly high interest rates, and because that does impact people who want to borrow money in terms of giving them a lower borrowing capacity. So it's something we keep an eye on, but it's important to recognise that I think different parts of the country perform so differently in relation to that. This is a slide that I like to sort of remind people that housing price performance really is not linked to, if you like, just if interest rates are going up or interest rates are going down. As we can see, during the prior tightening cycles, prices have moved in different ways. So 94 and then GFC are probably the ones with the most negative impact, as you can see there, and the others were quite positive actually. So it doesn't follow that because interest rates are going up, housing prices are going down, and I think particularly in Australia with it, as I say, undersupply situation being so prevalent, that's a pretty strong reason why sometimes things can move counter-cyclically. So if we have a look at this, we've seen this slide for a while. I think the important thing to look at there is what's happening, not 1 year after the last rate hike, but more have a look, what happens 5 years after, and we'll now be able to add the current cycle because we can see what's happened there after the first and second years. But property's an investment, but it's designed for the long term. So I think it's important to recognise that you're not buying it to try and sell next year and make a profit, but you're really looking at that to build out your asset base and try and hold that for as long as possible to maximise those gains and not incur any taxable disposal events. So when people ask us about investing in property in Australia, we do say to them it's as easy as pie, but this goes for many locations around the world really. If you're going to have population growth, infrastructure growth and employment growth in a region, you're going to potentially do far better if you're buying a property investment in that area to rent out than in one that doesn't have all of those attributes. So it's even better if you're moving into an area that already has good infrastructure in place and stable employment sites in place. So really, really important to look at those key fundamentals and try and locate your investment in such an area. So let's look at then the various capital city markets that we keep an eye on. Sydney, is still the most, New South Wales, the most diversified economy in Australia, but Sydney is the most expensive capital city market in the country, and it does have, I think, the highest downside risk due to affordability, where again people's borrowing capacities are being compressed at the moment. That should start being alleviated now with the first 25 basis point rate cut, and I think more of those will go on. So that's why I'm saying it might be 2025 might be a sort of year of two halves, where we have declines in the first half of the year in the Sydney market, but that may then be followed by increases in the second half of the year as people's affordability is improved and sentiment turns far more positive, I suppose. So they're the things to look out for there. And there is an undersupply, certainly in quality properties in most markets, and we seem to see people looking for that. So that ongoing demand will continue. Quarterly house price growth has slowed further, as we'll see in a moment, but immigration demand remains the strongest that we've seen. So if you look at Sydney, over January it's down 0.4%, 1.4% over the quarter, and it's still up 1.7% over the last 12 months. So, if you look at that graph, it sort of shows you what's happening there. I think we'll see a continuation of that in the next few months, but then later in the year, I think that will turn positive again. If we look at Melbourne, it was the capital city market that started trending downwards the earliest and has done by the greatest quantum. There's still very strong immigration in Melbourne in particular. Rental affordability remains very strong. Quarterly price growth has been trending lower. I think that'll continue, and the number of overseas students is still in a bit of a state of flux with governments trying to put quotas in place and caps in place, and Melbourne is very, very good at marketing its tertiary educational situation. So these are things that will impact the market. But again, I think Melbourne's going to be similar to Sydney, where we're going to see some more downward trending in that market. You can see here, January down 0.6, 2% down over the quarter, and Melbourne home values are now 3.3% down over the year, and 6.9% below their record peak. I think what we have to remember is that things in Victoria have been negatively impacted by excess taxes that the government's imposed after wasting an incredible amount of money during COVID and imposing horrendous lockdowns on people for a very long period of time. So there are some other issues that need to be worked through there, but we'll see what happens. And as I say, I think there'll be some continued weakness for a bit, and then there should be an upturn as we get the benefit of interest rate cuts coming through further in the year. Perth, on the other hand, the other end of the scale, it's had the strongest annual capital city price growth, highest population growth, highest annual rental growth, but now obviously that's slowing affordability there. So if you look at that, in January, Perth was up 0.4%, 1% over the quarter, and 17.1% over the last year. But so you can see the shape of that graph, and it's had a stellar run, and I think it's now obviously looking to retrace some of that affordability pressures coming in there, etc. So I think that will also continue to slow. We've already seen those numbers, particularly the quarterly numbers, come down. So I still see the smaller capitals, Perth, Adelaide, Brisbane, showing some pretty decent growth over 2025. Pardon me. And here's the situation, as we've looked at there before, the CoreLogic Hedonic Home Value Index, or FEB, is what we look at. The question there is there going to be a shallow downturn? And that's probably what's going to happen. So it's, the HVI is actually just down 0.3% from the record highs in October last year. And this was printed before Tuesday. The first rate cut was imminent and has now happened. So that, I think, will improve consumer sentiment. And I think in the back half of this year, certainly we should get renewed support for housing prices going towards the end of the calendar year 2025. You can see the quarterly change there. Sydney, Melbourne down 2%, being the largest decline. Adelaide up 1.8%. Brisbane 1.2%, Perth 1%. So really, really different numbers all around the country, and Darwin's also had a very strong period there. Canberra just now starting to slip into negative territory. So I think the next quarter will be really interesting. We'll have a look at these, revisit all these numbers again, and so you can see how things have moved in that 3 months period. So the other question we get from people regularly is, should I buy a new property or should I buy an old property? And really the answer is, it depends. It depends on what you're looking for. So if you have some skill sets, you might have been involved in the construction industry at some stage, or you might still be. You might be nearing retirement. You might be able to add value to an older property that other people couldn't do through their lack of spare time, lack of knowledge, lack of industry connections. Then that could be a really good outcome for you. On the other side of the scale, I suppose most of our clients really look at new property because they are really time poor. They don't want to be involved with tenants or property managers having to make repairs on their properties and maintain them excessively. So they want a sort of light touch, no touch type of approach. So they'll generally opt for new properties because they also find it easier to attract better tenants, and far easier just to rent out and manage in general. So no correct answer there, just depends on what you require. One of the great benefits, of course, I suppose, that we have in Australia are the Division 40 and Division 43 depreciation tax deductions, and certainly they are maximised on new dwellings. The building cost of a new dwelling can be written off at 2.5% per year for 40 years, and used to offset both rental income or other personally derived income. So very important. And then you've got the depreciation on chattels, fixtures and fittings, where it's best to get a quantity surveyor's report done so that you can legitimately claim all of those deductions when you submit your tax return each year, because all these items have a certain half-life that the ATO accepts. So what does all the data tell us, and where do we think is still a very good place to look at if you are looking to invest? Obviously that's different if you're looking for a place that you want to live in, because generally speaking you already know where that's going to be due to many other reasons rather than just the commercial outcome. So we continue to like the Southeast Queensland market. It has been a very strong market of late in the last couple of years, but I think it has many reasons to continue in the same vein in the years going forward. And that's, I suppose, the most important thing, because you've got to look at this, as I said, as a long-term situation and look at the factors that that can stay in place and remain to underpin growth in these markets. And I'll go through what some of those ones are. So there's still a substantial gap, obviously, to Sydney values. This is a really important one. The strongest interstate migration over the last 15 years, and that's been going on for probably the last 2 years. People are still moving to Southeast Queensland in droves. And that's important if you're looking to purchase an investment property somewhere, because if you're getting somebody moving from overseas, it's not likely that they're going to buy something immediately. So there's going to be a lag period of a number of years before they eventually go and buy something. They're going to rent something. If you're moving with your family from interstate, from one state to another, then typically those people are looking to buy something as soon as possible. And a lot of that, as I'll come through later, is happening. People moving from Sydney, say, to Brisbane, they've sold their property in Sydney, they can get much better value in Brisbane, so they're looking for a better quality property there. The work from home lifestyle is very important, I think, for the coastal markets there. A lot of people, particularly on the Gold Coast and also on the Sunshine Coast, availing themselves of being able to, I guess, travel intermittently to their office, which may be in Sydney or Melbourne, and live a coastal lifestyle at the same time. And the Queensland economy is very well diversified. It's sort of mimics, I guess, the Australian national economy in terms of diversification. So if you look at Brizzy, January up 0.3%, 1.2% over the quarter, and 10.4% over the last year. So, good results. As you can see from the graph, as with other markets, there's a diminishing downward draft going down through there. I think that will continue in the short term again, but where Sydney and Melbourne will go into negative territory, it doesn't really look like Brisbane will before some of those tailwinds from further rate cuts will feed through to the market and give people better borrowing capacities and underpin consumer sentiment in general. So, and I think Perth is in that boat, and Adelaide also. If you look at quarterly Australian population growth, it's important to have a look at not just the highest percentages, and that's, WA is still there at 2.8, Victoria at 2.4, and Queensland at 2.3, but also have a look at interstate arrivals and departures. As I said, that's probably a really big one. As you can see there, a lot of people leaving New South Wales, a lot of that be from Sydney, and moving into Queensland, a lot of that's southeast Queensland. So if you look at the bottom, the overseas arrivals and departures and net overseas migration, a lot of those people coming in, we see wanting to, in the first number of years, rent somewhere. So yeah, all statistics, all numbers, but have different impacts on property markets and therefore potentially different impacts on outcomes. If you look at that graphically, it shows you exactly what's happening. I mean, clearly the East Coast states and capitals are still showing, obviously, the good highest quantum of net overseas migration. And here also, as I said, for Queensland, interstate migration. So it's important to look at both sides of that equation. Victoria, as you can see, the outflow seems to have gone, which is a really good thing for Victoria, but it's still facing, I think, some investor backlash at this point in time due to increased taxes, and that has to work its way through, which I'm sure it will. So this is Brisbane population growth out to 2034, and as we can see, it's still going to continue attracting the highest level of internal migrants of any capital city in the country. And I think that's really important if you're a property investor. So you'll get less volatility, I think, in the outcomes there, and people generally like that because they consider property to perhaps be the more conservative part of their overall asset portfolio. So you can see that in terms of Brisbane's population growth, it's a pretty good story, I think, and I think it's one that's going to continue. So that's why it's a region that we continue to favour for people. If you have a look at the shortfall situation there, and we're looking there particularly at new dwellings being delivered, new apartments being delivered in sort of the inner middle ring of Brisbane, you can see that there's a massive undersupply, and it's not being rectified at this point in time. The cost of constructing new dwellings is still prohibitive in many instances, and there's just this constant, if you like, influx of people into the market, but there's not the new property there to meet that demand. And buyers are really looking, as I said, for quality homes and residences that they want to live in. They're looking for a lot of amenities and convenience, and I think if you look at particular subsets within markets, then high quality 3-bedroom apartments seem to be a very sought after, if you like, dwelling type. Modern townhomes, but again, it's very difficult to get those in high amenity areas. So I think that's going to continue, and certainly the numbers that we're seeing would point to that. So if you have a look at, if you look at just what's going to happen over the next year, it's going to be a very challenging situation if you're looking to buy a quality asset like that, and at the same time it's also challenging for people who want to rent them. So that's why I think that market is pretty stable in terms of ongoing increase in demand and ongoing, if you like, lack of supply. The other tailwind, of course, and it's not one that we should forget, is that Brisbane is going to be hosting the next, the 2032 Olympics. So, that's going to come around now more quickly than some would predict, I suppose. There's still a lot of work to be done in Brisbane in relation to finalising a lot of the development, the infrastructure that's being built, but there is a massive amount of infrastructure that's currently under construction in Brisbane. For anyone that's been there lately, they would be aware of that. If you have a look at things like the Cross River Rail, which a massive project, Queen's Wharf, and you go there and you see the casino having been completed. Howard Smith Wharves has just been a fantastic, if you like, entertainment F&B precinct that's been built and continued to be expanded. Brisbane Airport, now has a throughput numbers capacity of Hong Kong or Changi in Singapore. There's just so much happening in terms of infrastructure being placed there, and that leads to not just a temporary increase in jobs, but then a permanent one, and obviously makes productivity go up because people spend less time, say, travelling to places, and it keeps attracting people from other states because they look at it as being a nice area to go into with a good climate, but they have a lot more amenity at their disposal than, say, where they're moving from, and they have more money to be able to spend on that. So what's the value proposition? Well, it's really helping people not make the mistakes that investors often make. And that's, so for example, let's buy into a strong market of the future. And it's a little bit like what we see with equities. People will often jump in and buy something at a bit of a peak, rather than thinking about, how long is that going to go on for? I mean, obviously, if you're buying something like that, you think it's going to go on forever, but potentially you haven't done any research to justify that. So there is no lack of information, as I say there. It's just you need to have time to be able to utilise it, and then you also have to have practical experience, I think, as I say, to dissect those numbers, because you can see a lot of numbers, but they may mean different things if you look at, what they're going to produce in the future. Certainly any investment won't do. We always say to people, try and find something unique. Don't ignore your point of difference. And waiting too long is also something that a lot of people, I see, have an issue with, where they might say, look, I've been researching something for years now, and if you ask them what that's helped them to do, and they say, well, probably should have done something then. So all of those things are important, and we try and tie it together for people. If you look at things like this, so here, if you have a building with 1,000 apartments in it, and 600 of them or whatever are one-bedroom apartments with odd-looking floor plates, and they're small, those sort of things don't have any unique attributes. They're probably not going to help you in terms of excess long-term capital growth, and may even, give you some issues with rentability, although in this sort of market, I don't think that's a massive problem. Doesn't matter where that is, that's just, as I say, try and look at what dwellings the markets want, what do people actually want. And I just pulled Port Hedland out of there as a mining town, an economy that relies just on iron ore, but any place that relies on just one economic powerhouse can be problematic. So we like to stick to the larger capital city markets where possible, or other markets that have a number of different features that we think will continue to deliver strong growth prospects over the longer term. We try and tie that all together because a lot of people want that. They need that help just to get things happening. So we look at where there is already strong economic growth. What's the infrastructure growth look like? What's the employment growth look like? Is it sustainable in the long term? Is it sustainable into the future? And then what are your unique attributes going to be of the property you want to invest in? And is it a property that a larger segment of the market both wants and has the affordability or has the ability to afford? So all of those things are really important, and putting it together will give you a much better outcome than just having one or two of the pieces of the pie. Okay, so what are the opportunities for 2025 and definitely beyond? Because as I said, this is a long-term prospect that we're looking at. Just play this in the background in relation to where I was speaking about what sort of, what types of dwellings people in Australia in the markets want. And they're now sort of getting to the stage where, affordability in terms of cash purchases is really going through the roof. So a lot of these people are downsizers. They've sold their house, as I said, they might have bought a house in Sydney 40 years ago for $50,000 and they sell it for $5 million. And they have the disposable funds then to go and buy a beautiful apartment somewhere that has all the security features that they want, that is close to all the amenities, that cuts down on having to drive to places to travel, that has healthcare close by, all the things that people like. And now people are also looking for things like they might find if they live in an upmarket condo overseas, where they have really great gym equipment or gyms in them, great public entertaining areas, pools, barbecue areas. People can bring their friends around, have group functions there. So it's almost like resort living, if you like, but the resort living is everyday living for them. And the people that can afford to pay for that are saying, yeah, great, that's really what we want. So they're the things to bear in mind, I think. And here I just wanted to, show people what we do is look at things before, during and after completion. I'm here in Brisbane, Queensland. We're in the suburb of Windsor, and behind me is a new site that's being built named Sayre. This is approximately 4 kilometres from the CBD, in close proximity to Royal Brisbane Hospital, and you have a lot of amenity around this area in terms of transport, in terms of restaurants, bars, places you can go to in Fortitude Valley, which are clearly not far removed. And it's interesting to note that the skyline here reflects some of the urban development that's happening in the sort of inner middle ring of the Brisbane region. We always like to have a look at construction before and during and after, when sites are getting built, to give us a far better understanding of what our clients are going to see when they receive their finished product. It's something that we've been doing for a lot of years, and I think that's really important, to assist people with trying to picture the end result from a render. So we're talking about a new dwelling there, and it's really, I suppose, very satisfying when you see something being built and it looks exactly like the photo or the range of photographs you were given at the beginning. Here we're talking about amenities being close by, hospitals, restaurants, entertainment precincts, public transport, and so forth. And it's something that is really important to not just the purchaser, but then you have to think of who's going to be living there. So in this instance, if you're an investor, it's going to be a tenant. They clearly want to have all those things as well. It's not limited to people who can afford to buy properties to live in. Certainly many people, especially people who are rent vesting now, are tenants in somebody else's property, and they want everything that we've just spoken about. So if you look at who pays for your property, typically speaking, if you look at the pie and you're an Australian resident investor, that's a sort of mix. I mean, the majority is paid for by the tenant. Then if you get high depreciation allowances on your property, you're certainly given a free kick by the tax office, and generally you don't have to put in much of a contribution individually. Now, this varies. If you're a non-resident investor, you can't offset those depreciation items, the tax deductions associated with those against your personal exertion income, so you've got to save them up. And this is something that's really important for people to understand, because if I flick onto that, that's the same property for an Australian resident investor. As you can see in this instance, that doesn't actually cost them anything for that on an after-tax basis. But for someone who's an Australian expat living and working overseas, you don't miss out on that. It's just that you save up those tax credits for when either you sell a property and want to offset capital gains, or if you repatriate in the future, you can offset those tax credits against your personal exertion income then. So that's really important because if you're coming from, say, a low tax environment or a zero tax environment, like perhaps the UAE or Singapore or Hong Kong, etc., and then you come back to Australia, you're facing a very different situation. That often gives people, at least 12 months or perhaps even longer to settle into that new, far higher tax system on a gradual basis, because they won't be being taxed at the top rate because they have all of those tax credits in place. So, and if you utilise that with a bit of forward planning, it can really actually work well for you. So something that people need to bear in mind. Here it is, who pays the costs over 10 years. So really at the end of the day, as long as you have cash flow, then this isn't really an issue because the end result's going to be largely the same. In closing, I suppose, we've got to look at what property investment should represent to you. It's investment, it's not speculation. So by nature, investments generally take a longer time period to mature properly. And as we can see there, if you're waiting and holding your property sort of 20 years plus, time does do a lot of the work for you in relation to how much you're going to eventually crystallise as a gain, or potentially keep further and perhaps put into your wills. But as we can see, most people, or the median hold period that people keep properties was 8.8 years, and most people, you can see that bump there in that graph, will tend to sell out potentially long before they should do. So it's important to make sure you don't just sell something because you can. In fact, most people usually sell things because they have to. So looking at and researching, making sure that whatever you're purchasing is affordable and you think will be affordable in the long term is really important. But then this is also driven by human nature. Quite often people say, oh God, I've made really good money on that and I'm just going to sell it. Not thinking about or worrying about what tax consequences that may deliver them, what they're actually going to do with the money once they get it. So it can just lead to people transacting without a clear plan for what they're going to do. And generally speaking, we find if you've done your job in the beginning, had someone help you with the research, helped you get the right type of asset in the first place, you can just let time continue to do that work for you. So we've been around, as I said, for a long time, over 30 years. We have the ability through our lending business, Aussie Loan Guru, to assist Australian expat clients with a much higher lending ratio than they could potentially obtain, 85%, without having to pay bank mortgage insurance. We also do that obviously for our clients who are Australian domestic residents, and obviously more if you're a doctor, a lawyer, other professional. So a lot of boutique benefits, I suppose, from being able to do that for people, maximise their tax benefits, then maximise their ability to grow a portfolio perhaps at a more rapid pace than they would otherwise. Potentially, as I said, you won't legally pay any tax on those properties if things are structured correctly and they have the right attributes in hand. And we have access to properties that that the market is looking for, which are in very high demand. So it gives you some exclusivity and gives our clients an opportunity to participate in some pretty happy outcomes. Look at things, here are 4 sort of steps to effective investment. Obviously, we get a lot of inquiries from people around the globe these days. It's good to have a Zoom meeting to find out exactly what people are looking for, what their personal situation looks like, and the sort of assistance that they want. And sometimes it can be very specific in relation to certain things, and many people want things to be far more broad and overarching. So we can provide both. As I said at the beginning, just reach out. So what we tend to do, if you look at this in a stylized situation, is do all of that. Give people an initial consultation, look at their situation from a financial viewpoint, look at what they may want to get out of this whole process, and look at some comparisons. And I think most importantly is assist them with ongoing access to a panel of experts in most things that you need from a financial or commercial viewpoint when you purchase property, legal, accounting, tax, etc., so that people have someone there to assist them and help them make well-informed decisions into the future. Now we do have some questions, and I know that we've got a few things here as well. Let's have a look. Well, one of our viewers has dropped off, but the question was, and it's from one of our viewers in Singapore. He said, looking at 15% deposit option to maximise tax benefits. I'm looking at such a small loan balance that the tax credits would be small with a 10% deposit. I'm not really sure that I understand that question, Rob, so we might be able to look at that individually, because obviously if you have a small deposit, then you have a large loan. And the tax deductions on the interest are what's going to be of value to you to offset against other taxable Australian income. So generally speaking, that's rental income, and that should maximise those benefits. But I'm happy to, if you want to contact me, take that up with you offline. Rod Jackson asking, how long can the property boom in Australia last? Pretty good question, Rod. I don't think anyone has a crystal ball, but as you can see from what I've been saying during the presentation, I think that we'll get a shallow downturn in the first half of this year, and then I think we'll get an upturn again in the second half of this year. This is on a sort of amalgamated all up basis. You saw that I went through the various capital city markets. I think they're going to react differently. I think the downturn in Melbourne and Sydney will be more pronounced than what's going to happen in, say, Adelaide, Brisbane, Perth, and Darwin. So overall, I think at the end of the year, as long as what most people are predicting now, if we get 3 further interest rate reductions by the RBA, it'll bring, there'll be 100 basis points in total, bringing it down to 3.35%. I think that will give people some more confidence to go into the market, and more importantly, it'll also benefit them from a higher borrowing capacity if they're going to be borrowing money from the banks to make those acquisitions. So I think I can't see anything terminating the growth in home values at this point in time. I think when you say boom, I think the boom at this time has already happened, and now you're getting good growth. So yeah, happy to take that up personally as well. Let me just go on here. Anyone else have any questions there that they may want me to have a look at? Question here from one of our viewers in Hong Kong. Interested to hear your short, medium and long-term view on buying units to houses. The unit market in Brisbane has overtaken the housing market in terms of growth. Yes, and that's what I was saying earlier on in the presentation, that whilst we've had these higher interest rates, people have been looking at affordability, or being forced to look at affordability. So they're saying, I want to buy something that is close to all of the amenities that I want, that I wish for. I can get a great 3-bedroom apartment instead of a 3-bedroom house, and I can afford it. So that's happening for, as I say, 2 bedrooms, 3 bedrooms, 2 plus multi-purpose room. The sort of owner-occupier end of the apartment market is outperforming freestanding homes in quite a number of areas now. And that's not just due to that part, that affordability part of those people, but it's also then due to the other end of that, where you've got a lot of people with a lot of cash that simply want, you know, the luxury and amenity and security that style of living might, that resort style living, which is super, you know, plush if you like, that they can't get in a freestanding home. They don't want to get a freestanding home because, you know, they don't want to have maintenance issues, that they don't want to have any of the other issues that potentially have taken them out of that market where they've already sold their main residence. So I think they'll continue. Affordable building as far as materials. Are there alternatives to current cost of build? Gee, I wish we could find something, but it doesn't seem to be. And I think one of the issues there is not just cost of goods, it's cost of labour. And when you've got both federal and state governments undertaking such massive infrastructure projects as we currently have in Australia, a lot of the skilled labour and construction industry is being diverted to working on those projects, and that labour force is being taken out of the area of, you know, building residential home dwellings and freestanding homes. So that's not likely to go away, and that is a major issue. And that's what I said during the presentation, you know, that undersupply that we're seeing, I think is continuing to build up rather than diminish. So unfortunately, I don't see if there is a good solution at hand. But yes, certainly hope, and saying thanks for your comment again, certainly hope for affordability to improve as we see those interest rate cuts come through. And then hopefully, you know, who knows what the existing government, if it remains in office, will do in its next term, or if there's a change and the coalition wins the next election, what they're going to do. Because I think a lot of the issue is also red tape and bureaucracy, and that is something that definitely can be worked on. And I hope it is, because it'll make everyone's lives so much better. What are some good programs to help offset the cost? Look, most of the cost is really inbuilt into the process. So if you want to go and build something, it's difficult to reduce the cost, because whoever's building that in the first place generally has already gone through and tried to ascertain the most efficient and cost-effective way of making that building. I guess from an individual's viewpoint, if you're going to build something, make sure you get, you know, a number of quotes for what it is you want to build, so that you can then have some sort of measure in terms of what the marketplace is saying. And I think that gives you potentially the best outcome. I don't know exactly, but I'm happy to take that question again personally if you want. Just send me a message on WhatsApp and we can set up a quick Zoom. Okay, nothing else from anyone there? If there isn't, I wish you all the very best and look forward to seeing you at the next quarterly review. We'll see how, you know, some of those numbers have played out in terms of what we're expecting or predicting and what actually happens. Up till now, that's been a good outcome. You know, we had the February rate cut, which we predicted 4 to 5 months ago. So all the very best.